Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Chinese economy, and specifically to talk about the Chinese stock market. Now, as I've said many times before, the performance of a stock market usually mirrors what's going on in the economy. If an economy is doing really well, therefore all of the companies are performing well, they're increasing their revenue and their profits, then generally speaking, you would expect the share prices to be going up, and therefore the whole of the stock market should be rising. And equally, if your economy isn't doing very well, if the companies within it aren't performing well, if they're not growing their revenue or their profits, or maybe they're making losses, then you would expect share prices to go down, and therefore the index would fall, and that would reflect the poor state of the economy. And a few months ago, I posted a video talking about the fact that the Chinese stock markets had seriously underperformed against most of the other stock markets. And this was as a result of the fact that the Chinese economy has been struggling over the past few years as a result of the property crisis. We saw the property bubble burst in China, and the developers are still trying to recover from that situation. And on top of what's happening in the property sector, we've seen lots of other Chinese businesses struggling as well. But recently there's been a surge on the Chinese stock markets. And I've had lots of messages from people saying, hey, Joe Blogs, you're not talking about the Chinese stock market anymore. Have you seen it? It's one of the best performers in the world. But in this video, I want to go through exactly what's been happening in the Chinese stock market, because the surge in prices that we saw at the beginning of October wasn't actually driven by the performance of the Chinese economy. We haven't seen a sudden turnaround in all of the businesses. We're not seeing the property sector suddenly becoming buoyant again. What we're seeing is a huge stimulus package that was announced by the Chinese authorities at the end of September, causing the markets to bubble up. But now we're starting to see that bubble bursting. So in today's video, we'll go through exactly what's been happening. We'll look at that stimulus package that was announced at the end of September, and then have a look at what the impact of that was on the Chinese stock markets. We'll also talk about what's happened over the past week or so, because the markets have started to calm down again. In fact, they've been tumbling. It's been the worst performance on the Chinese stock market since 2020. And we'll talk about why that is. We'll talk about whether or not the markets see that stimulus package as fixing the Chinese economy, or whether this is just a short-term shot in the arm for the market. We'll take a look at how the Chinese market has performed over the past 5 years and how that compares to the S&P 500 in the USA. And then finally today, I'll wrap up with my summary as to what I think has been happening on the Chinese stock markets, what's likely to happen over the course of the next 3 to 6 months, and what all of this means in terms of the Chinese economy. But before we get started on all of that, I'd like to say once again, thank you so much to everyone that's supporting the channel. Firstly, actually, if you haven't already subscribed, please hit that subscriber button, because I'm trying to get to 400,000 subscribers, so if you could help, that would be great. But thank you so much to my long-term supporters. If you support me through Patreon, where you can get early access to my videos and watch them advert-free, or YouTube membership, where you'll also get early access, or buy me a coffee membership, thank you for that support, really do appreciate it. And if you've bought me a coffee or sent me a YouTube super thanks recently, wow, thank you so much, really do appreciate every single one of those. At the start of 2024, the prospects for China looked promising. Lots of market commentators were saying that China was going to have a very strong performance, and it would hit GDP growth of 5% in the year. However, that level of enthusiasm soon disappeared, and over the past 6 months, we've seen the Chinese economy starting to struggle. And on the 24th of September, the Chinese authorities announced a raft of stimulus measures to try to boost the economy and to get the stock market moving back into positive territory. And those stimulus measures included reducing the reserve ratio for banks. So basically, banks no longer hold as much cash as they did previously. So that means that they can lend more money to their customers. And it was estimated that the reduction in the reserve ratio should free up around 1 trillion worth of loans for Chinese companies and individuals. Certain loan rates were cut to make it cheaper to borrow money. And for savers, deposit rates were reduced to encourage people to spend more, take your money out of the bank and start spending it. And the deposit needed on second homes was reduced from 25 to 15% to encourage more people to start buying property. And in addition to all of those measures, the Chinese authorities also set aside more money for funds to buy shares. So basically go into the market and start buying up stock. And as a direct result of this stimulus package, the stock market started to take off. This chart shows the movement in the CSI 300, which are basically the 300 largest companies in China, over the past 5 years. And what this shows is that between March 2020 and February 2021, as China started to come out of the first wave of the COVID-19 pandemic, the stock market in China saw significant growth. However, after peaking at a level of around 5,800, over the past 3.5 years, the CSI 300 has been in significant decline. And on September the 13th, 2024, it hit a new 5-year low, which was one of the reasons why the stimulus package was announced. If you now zoom in and have a look at what's happened over the past 30 days, you can see there's been a remarkable turnaround. On September the 23rd, the day before the stimulus package was announced, the market was sitting at a level of 3,211. However, 2 weeks later, on October the 8th, the market had risen to more than 4,300, representing growth of 32% in a 2-week period. Now, that's obviously a remarkable performance for an index. This isn't an individual share that we're talking about. This isn't Nvidia suddenly going up 30% because they've announced the latest, greatest chip that everybody else wants in the world. This is an index of 300 of the largest companies in China. So basically, every single one of those companies has increased in value by more than 30% in a 2-week period. And the messages that I've been receiving basically have been telling me that this means that China is now back on the road to recovery. Everything is rosy in the garden. However, it isn't really the situation, is it? Because you need to look at what's driving that growth. And the reason why the stock market has gone up so significantly in a short period of time isn't because all of those 300 companies announced record results and that they developed new groundbreaking products that everybody in the world wanted to buy. It was because the Chinese authorities had released this stimulus package that was designed to get everybody excited again about China and excited about the prospects for the stock market. However, when you release a stimulus package like that, it doesn't fix everything overnight. And what we've seen over the course of the past week is that the markets are now starting to return back towards reality. This chart shows the movement in the CSI 300 over the past 7 days. And what you can see here is a rapid reversal of some of the growth that was seen over the previous 2 weeks. At the start of this period, the index was sitting above 4,400. However, by the close of business on October the 11th, it had fallen to 3,886, which represents a fall of more than 12.5%. So why did the market go up so rapidly, and why is it coming back down so quickly? Well, one of the reasons is because there is a lot of cash sitting in China looking for something to do. Over the past 25 years, there has been an explosion in the property market in China. It was seen as a no-lose gamble. You bought property, it went up in value, you made a profit, everyone's a winner, and then you buy another property, that goes up in value, you make more profit, and you just keep doing that. And that's what happened in the first 20 years of this century. Everybody in China wanted to buy property. There were literally billions and trillions of dollars being pumped into the market over that period. However, in 2021, the authorities decided that they wanted to put the brakes on the market, and they introduced the 3 red lines policy. And the 3 red lines policy introduced 3 financial tests for all of the property developers in China. And they had to pass all of those tests to make sure that they could continue borrowing large amounts of money from the Chinese banks. And most of the big developers failed at least one of those tests. Many of them failed all 3, including Evergrande, which I think was the most famous example of. It was actually the biggest developer in the world at that point. It had the most debt, over $300 billion. That company is now in liquidation. So the property market started to go into free fall from 2021 onwards. And as a result of that, a lot of investors have been pulling out of the market. They haven't been continuing to pump billions of dollars into it. And so there's a lot of cash sitting on the sidelines waiting for something to do. Now, as we saw earlier in the video, the stock market performance has been very weak over the past 3.5 years. And so investors haven't been that keen to pump a lot of money into it. But when this stimulus package was announced and the market started to rise, a lot of these investors got excited. And so they started putting money in. And as they did so, the market started rising because there was an increase in demand for shares. And so they put some more money in and it went up further. And so they put some more money in and it looked like a no-lose gamble again. However, unlike the property market, it wasn't a 20-year run, it was a 2-week run. So at the end of the 2 weeks, the market started coming down again, which has caused nervousness. And so investors now are sitting on their hands, and some of the investors are actually taking their money back out again. And that's how you get a run on the market. It's a classic scenario of when prices are rising, everybody wants to buy. As soon as prices start falling, everybody wants to sell. And interestingly, some of the exchange-traded funds, which are basically the stock market index trackers that have been built up all across the world, this is basically the sort of thing that your pension is invested into. People put money into tracker funds because they want to benefit from the growth of a market. And the exchange-traded funds have been very cautious about China, so these haven't been growing hugely over the past 12 to 18 months. However, as soon as the market started to take off, the ETFs suddenly started piling in because lots of investors wanted to put money into China in exactly the same way as the Chinese investors we just talked about. All of the investors around the world suddenly saw China as the next big thing, and so they wanted to put money into it. And Bloomberg reported that 5 leading ETFs that are listed in the USA that invest specifically in Chinese stocks received around $4.9 billion in cash in the week when the Chinese stock market started to take off. The iShares China Large Cap ETF, which is run by BlackRock, saw the biggest single inflow totaling $3.5 billion, while the CraneShares CSI China Internet Fund received $1.4 billion, all hitting records as investors returned in waves to the Chinese equity market. So basically what we're seeing here is a gold rush. Everybody wants to get on board the next big thing, the next sure bet, where you can double your money in a short space of time. However, unfortunately for all of those investors, things have started to turn against them, and the market is now tumbling, as we saw from the graphic from the last 7 days. And Bloomberg have now reported that the downturn in the market is a warning that more stimulus is needed to keep the rally going. And the chief economist at Natixis has said that people will realise that there's no fiscal side to this stimulus, that it's all monetary, propping up stocks and so on, and that is quite dangerous. But don't worry everybody, because potentially there's another stimulus package of around $283 billion that may be announced at some point in the next 24 hours. The market is now forecasting that China will sell more government debt to expand public spending through the end of 2025, with special bonds being the most likely option. So basically what that prediction is saying is that China should take on more debt and use that debt to try to boost the stock market, to artificially inflate stock prices so that everybody feels good about the state of the Chinese economy. But let's have a look at exactly what's been happening to the Chinese stock market over the past 5 years and compare it to the S&P 500, which are the 500 biggest listed companies in the USA. This chart shows the movement in the CSI 300 over the past 5 years, and really what I'd like to focus in on here is what's happened since February 2021, because over the last 3.5 years we have seen a dramatic and continued fall in the value of this index, and this goes hand in hand with what's been happening in the Chinese economy. As the economy has started to weaken and slow down, the value of the stock market has fallen. If we start off by looking at what happened between February 2021 and May 2022, there was a significant decline in the value of the index. From a peak of around 5,700, it fell to around 3,900, representing a fall of almost 33% in a 15-month period. And if we compare that to what happened to the S&P 500 over the same period, at the start of February 2021, it was sitting at around 3,900, and by May 2022, it had increased to above 4,100, representing growth of 5%, which is obviously significantly different to the huge fall in the index seen in China. Now, interestingly, in May 2022, in order to address the fall in the stock market, the Chinese authorities announced a stimulus package. And as you can see, between May and June 2022, this resulted in a sharp increase of around 13% in the stock market index. However, that rally proved to be short-lived, and by October 22, the market had fallen by a further 23%. Now, the authorities, in order to address this, decided that they were going to introduce a stimulus package, which resulted in the index recovering significantly by January 2023. However, once again, the stimulus package didn't have a long-term impact on the market. And in the 12 months up to January 2024, the market fell by more than 24%. Now, as I said at the start of today's video, at the beginning of 2024, the prospects for China looked rosy. And as a result of that, the stock market index started to rise. And between January and May, we saw a 16% increase. However, as the economy started to struggle, the index started to fall, and we saw a 13% reduction between May and September 2024. Now, obviously, we've just discussed the recent rally, so I won't go through that in any detail. But I think what we're seeing here is a consistent pattern whereby the stock market has been falling in value as a result of what's happening in the economy. And the authorities in China have undertaken a number of stimulus measures to try to kickstart the value of the stock market. However, over the past 3.5 years, those stimulus measures have had a very limited impact. They tend to work well for a few weeks or a few months. However, the long-term issue is that if the economy isn't doing well, then the market will go into decline. And the question we have to ask now is the latest stimulus package just another one of these short-term blips? Will it bring the market back up for a short period of time, and will we see the market starting to deteriorate again? And just to jump back to the S&P 500 to look at the comparative position, you can see that over the past 3.5 years, there has been significant growth in the index. There was a reduction following Russia's invasion of Ukraine, which threw everything up into the air in terms of the global economy. However, the index has bounced back strongly and is currently trading at its highest ever level. And if you look at the shape of this chart and compare it to what's been happening with the CSI 300 in China, it is vastly different. In fact, it's the inverse position. The biggest companies in the USA have been seeing year-on-year growth as a result of the fact that the economy has been doing well, and therefore the performance of those companies has been strong. Whereas over the past 3.5 years, the Chinese economy has been struggling, Chinese businesses have also been struggling, and that's been bringing the index down. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening with the Chinese stock market right now is really quite fascinating. And also I'd had a lot of messages from well-wishers in the first couple of weeks after the stimulus measures were announced saying, hey Joe Blogs, could you make a video about the Chinese stock market? I'm interested to know why it's gone up 30%, or maybe not quite as polite as that. There's a lot of keyboard warriors saying, hey Joe Blogs, you're not talking about the Chinese stock market anymore, are you, buddy? Well, I wanted to wait until things had settled down a little bit. And actually, I don't think we've got to the point of equilibrium. I don't think we've seen the markets coming down fully as yet as a result of the spike that we saw in prices. And as we've talked about in today's video, the main reason why the stock market has gone up isn't because the Chinese economy is now doing really well. It isn't because we've seen record results announced by the biggest businesses in China. It isn't because China is suddenly the biggest economy in the world. It's because the Chinese authorities have announced a stimulus package. So what they've done, they've changed the rules to make it easier for the banks to release more money into the economy. So they've basically reduced the reserve ratio, freeing up $1 trillion yuan to be able to be pumped out in the form of additional loans. They've also reduced the price of those loans, so it's cheaper to borrow. So that's likely to encourage more companies, including property developers, to borrow more money. And they've also made it less of an incentive to hold money in the banks. They've reduced the deposit rates that they're paying to both corporates and individuals for holding money in the bank. So all of that is a stimulus to get people out and spending and to try to grow GDP. And they've also introduced a number of measures to try to get the property market going again, because the property market constitutes around 25% of the Chinese economy. So obviously it's really important to get that back on track. So the reason why the stock market suddenly spiked 33% was because investors suddenly got excited. They saw things happening in China and everybody wants to make a quick buck. So a lot of money poured into the market. Around $6 billion in the USA alone went into Chinese ETFs. And this was because investors who are reading in the papers that stock market prices have risen 5% in China are thinking, I want to get on board. I would like to make a 10% profit in less than 5 days. So a lot of money poured into the market. And as we know from simple economics, if demand rises for anything, it pushes up the price. So when demand for Chinese shares suddenly spikes, we see an increase in the price of all of those shares. And that's what's been happening over the course of the past couple of weeks. But what goes up must come down if it isn't supported by fundamentals. And we haven't seen a fundamental change in what's happening in the property market. We're seeing new home prices falling, we're seeing demand for property falling, and we've also seen lots of property developers actually becoming illiquid and filing for bankruptcy. So there are very bad things happening in the property sector. That's not something you can fix overnight. You can't announce a stimulus package and expect the property market to recover in one day. That's not how the property sector works. It will take a long period of time to try to rebuild confidence in China, to get people wanting to buy property again, to get the developers back to a position where they're actually got enough cash flow to build out all of the apartments that they've taken advance payments for. So property sector is going to take a long time to fix, and so's the rest of the economy. You can't just give it a shot in the arm and suddenly China's back on track. It's been struggling because of the fundamentals. There are serious problems right now. We talked about it in previous videos. They've got a high level of youth unemployment. So people who are aged between 16 and 24 are really struggling to find jobs. We've got a very low retirement age. So people are actually being forced to retire either at 55 or 60 in China. So there's a lot of people hitting retirement that the state needs to keep funding. And in order to do that, they need to earn more tax. But they haven't got enough tax to pay all of the people for their pensions. And so there's a real problem there. They're actually increasing the age of retirement probably to around 63. And it'll probably get to the same as the rest of the world, 67, at some point over the next few years, because they've got 1.4 billion people. It's a huge country. So all of the fundamental problems are still there. But the fact that the authorities announced this stimulus package got everybody excited. But as we also saw over the past 5 days, it's been one of the worst performing stock markets in the world. And actually, there was a day of trading that was its single worst in China since 2008, since the global financial crisis. And that tells you that things are not good on the stock markets. So anybody that's putting money into the Chinese stock markets right now is really taking a gamble. They're looking at a short-term gain rather than a long-term investment. When we looked at the S&P 500 chart over the past 5 years, you could see that the index has been growing gradually and consistently over that 5-year period. When we looked at the CSI 300 chart, it's been doing the opposite. It's been going down. If you'd have put money into the Chinese stock market at any point in the last 5 years, excluding the last few weeks, you'd have lost money because the index is constantly falling. So that doesn't really encourage people to start putting their life savings into the markets. But when you see it going up 30% within the space of 5 days, people suddenly get excited, and that's what's been happening. However, that money is now starting to come back out rapidly. And it'll be really interesting to see what's announced by the Chinese authorities over the course of the weekend, whether or not they announce another stimulus package. It's expected to be around $280 billion. But if they do, all that will do is boost the market again for a short period of time. It isn't actually fixing the fundamental problems in the economy. All it's doing is providing capital for fund managers in China to buy shares, which drives up the price. It's allowing the banks to lend more money, which in theory should boost GDP and therefore gives everybody a short-term boost in terms of some of the metrics. But they need to fix all of the underlying issues if the economy is going to recover, and therefore we'll see long-term growth in the CSI 300. So the overall summary of today's video is that the stock markets in China have been moving around wildly over the past few weeks. We saw an increase of over 30% at the start of October. That's now starting to reverse. We've seen around a 13% fall so far. So on a net basis, we've got around a 20% increase over the last 3 weeks. However, the big question is, can China sustain that level of performance? Will they continue to grow? Will we see the stock market going up over the course of the next few weeks, or will it come crashing back down? And I think the answer to that is dependent on more stimulus measures. If China announce continued stimulus measures, then the markets may continue rising for a short period of time. However, as we saw from the long-term view, the stimulus measures generally only last for a month or two, and then the long-term view kicks back in and the market keeps coming back down. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end. Here's something to put a smile on your face.
Don't touch the ears, Steve. Not everybody likes having their ears breathed into. It's not something that everybody likes. That's disgusting. No, don't do it. Do not bite the ears. Steve, no, don't bite Steve. Not the ears, okay? Not the ears. No, 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 no. Just ears are not there for you to nibble on.